Good morning, everybody. Welcome to the Flow Show. It's BOE Day, and lots of anticipation around this one for once. Makes a change, but nice to get some volatility for the quid. Hopefully, touch wood. Knock, knock. Morning, Kay. All ready?
Good morning, Ryan. Good morning, everybody. We are as ready as we can be, my friend. So we are fully expecting the sterling to go on a walk. But we don't know which side yet. We don't know which side of the park yet.
Yeah, and we don't know whether it's going to trip up and fall down a hill or jump in an elevator and shoot to the moon. But at least that's a good thing about it. We should get some good volatility around this one to get our teeth stuck into. Again, touch wood. Right, well, before we get on to the Bank of England, let's see what's going on elsewhere. Now, it seems suspiciously like Mr. Ueda at the Bank of Japan has had a telling off from those in the government, Ministry of Finance, because after his comment that yen weakness isn't really impacting inflation or anything at the moment, which helps send yen pairs higher, he's done nothing but talk about FX since then. He says rapid one-sided yen falls are negative for the economy and undesirable. He said that a couple of times over the last few sessions. He says FX moves are among the important factors that affect the economy and prices. We'll naturally think about policy action if Forex hits the price trend. Says the BOJ will scrutinise the recent weak yen in guiding monetary policy. He does expect positive wage inflation cycle to strengthen. We also had the Bank of Japan summary of opinions from the last meeting, the April meeting. And altogether, probably as expected, a bit of a more hawkish shift to the comments there. I've picked out a selection of them. One saying that if forecasts under the quarterly report are met, interest rates might rise to levels higher than markets currently price in. They said that one option would be to hike rates moderately in accordance with economic, price and financial developments to avoid a shock from an abrupt policy shift, i.e. a gradual raising over time rather than jumping in hikes. It says they must hike rates with appropriate timing as the likelihood of achieving the forecast heightens, and that the bank must deepen the debate on the timing and pace of future rate hikes. So a bit of a hawkish sounding message there in the, we'll call it the minutes, that's what it's sort of like. And what do you make of Ueda, Kay? Talking FX more and more now.
We've been touching up on it, and again, I've been commenting on it in our chat room. It's possible that telling off. In the meantime, we had also those cash earnings out, but those were for March, which were underwhelming. But I think we need to see the April-May numbers before really forming a much better idea about the picture, okay? Because March is still the end of the past fiscal year, but those were still a bit underwhelming because we know they had very good pay rises last year, but then you look at those cash earnings, and they have been revised lower as well the prior month, so that's not a great picture yet. But yeah, I think as I was saying in the room, I'm not sure, but there is a possibility that he's preparing this market for a much earlier rate hike than it is pricing now. We are now pricing possibility, what is it, anywhere between September and November or so. Let me see, October, really. That's where the most people are expecting it. But I've got the impression that he's preparing us for an earlier rate hike now. Next meeting, 14th of June, would be a very big surprise. But since he's been talking so much about the yen levels, and must say that the summary of opinions were a little more hawkish than I thought. So I'm not going to rule it out. In the meantime, market business as usual, interest rate differentials still remaining quite high, but so the market is still selling yen, which is the weaker side of it all, because it's very hard to be long yen. Even imagine for a second that we don't get any interventions anymore, and we need to wait. Even if they hike in June, we need to wait for another month before they do it. So you're looking at a month of funding as well. So that's a bit of a hard one. So for the time being, the market continues to sell yen, but I'm starting to think that they may hike earlier and much earlier than the market thinks now, and then we are going to need to really watch very, very carefully what it means for the Japanese investor flows.
Yeah, yeah, I agree with that. I think that comment that the bank must deepen the debate on timing and the pace of future rate hikes was one of the key lines in that one. That
Yeah.
for the hawkish slant, they do want to be talking about it and getting it out there. Obviously, CPI data is very important for them, so we have to watch the next numbers there. But as Ueda said, when they ended negative interest rates, it's not just inflation that's important. They're going to take a broad view of everything. And yeah, those labour cash earnings, like you say, March. Okay, so potentially before all the wage hikes, the bigger number, which never shows on this calendar, was that the real cash earnings was down 2.5%.
Yeah,
2.5%.
that's no good, huh?
No, and
That's
that was
not good,
worse than the
especially
prior.
here where they had already 3.8% rise last year, and I think that's also where the market jumped. We had this little bit of a reaction after the minutes, went down like 30-40 points dollar yen, I think, if I saw the timing correctly. I think it was there, but then I think seeing those earnings, the market went like, well, yeah, good luck, because if the problem is as well, if it does not translate in real wages going substantially up, that's another trap for the Bank of Japan, because
Yeah,
they will have it tough to raise interest rates well higher than what the market may expect.
yeah, and it keeps them in the hole that they want to dig themselves out of. But this is Japan speaking, so it's not going to happen overnight. But they are in a bit of a situation. They need to
Yeah,
get rates up. They've still got a window of opportunity. They're still in it, but
yeah.
if the world turns more negative on growth, they're going to catch the same cold, and then they'll be in trouble
Mm.
again.
Yeah, the thing is, we will, because the next meeting is the 14th of June, so we will have those April pay numbers. And if they really show the already a decent rise, that may actually help the Bank of Japan make a decision, an early decision.
Yeah, so I think that whether they hike at that one, I don't know, but at the very least, probably should get a hint of something to come, a stronger hint of something to come. But yeah, that's for then. Plenty of things can happen until that point. In the meantime, Suzuki and the rest of the gang are still waffling on with the same old lines. There's been no change in metric from them. They haven't stepped it up, stepped it down, or anything like that. TV Tokyo, a strange source for this one, apparently know what's what, and they said that Japan intervened twice last week in FX markets. You probably know this station better than most, Kate. Not one that usually spills beans like this one.
No.
Not that it really matters anyway.
No, I was joking about it in one of our rooms. I said, when I just went to Japan, my youngest one was about 8-9 years old, and the only thing that he picked up some Japanese because there was this famous ad running on TV Tokyo for the Zurichi insurance, and it was like very childish song accompanying it, and there he picked up some Japanese, but that's about the only thing I remember of TV Tokyo. I would have expected NHK or Asahi or so, or rather to come up with that, but yeah, for some reason They may have run in one of the MOF officials in one of the karaoke bars in between two sake drinks and him talking about it. I don't know. It's a strange one.
Yeah, not that it matters anyway, because we all think they intervened.
Yeah.
Right. Well, moving on over to the ECB, and we've had ECB's Wunsch saying he sees a path for initiating rate cuts this year. The costs of remaining tight for too long seem to outweigh the cost of premature easing. There is room to cut 50 basis points, but when will depend on the data. Sees significant risks still in wages and service prices. ECB's Holtzman, if the time comes in June, further steps will certainly follow, but I see no reason at all for us to cut key interest rates too much too quickly. Cade ECB lot, we've got this June stuff, it's done and dusted. Holtzman, he's come around to the idea of cuts, but he's not willing to let anything else come thereafter very quickly, is he?
Yeah, he's now going to more neutral, let's say, and talking both ends of the spectrum. Well, yeah, I think it's tough for anyone because I mean we know we've been endlessly talking about it that we are data dependent for virtually everything right now. But yeah, I think June, as we said, is baked in, and what comes afterwards is a question mark, you know. And as you have been rightfully saying, like for a long time already, they will not want to make the mistake to the other side that they did when inflation was running away. So if people are expecting several cuts over the year, it may not be July the next one. So does it matter much? It depends. It will matter by how much they cut in June, which is probably going to be a cautious 25 basis points. But then we will have to see what they tell us more about if they found anything to justify more cuts. But yeah, I mean,
Do you think they could go a lesser amount than 25
I
to
wouldn't
push
think
through
so.
a July hike? It's not really their MO,
No, I
but
wouldn't think so.
no.
But I
Just
mean, they actually that's one if that already would be the possibility. I don't see it right now. It's an extremely low probability for me that they would do less than 25. But I mean, that could be the July surprise if they really
yeah,
do only
exactly.
1/8 of a percent or so.
Yeah, do 15 pips in June and 15 pips in July, and you know you've pleased both the Hawks and the Doves. Yeah, I'm just talking off the cuff here. They're not a bank to go in those increments, but who
I
knows?
I don't think they will go in 1/8
No.
or like 12.5 BPs or 15 BPs or 10 BPs or so. I don't see it right now. And there's also not too much of a reason unless we get like 0.01 CPI declines and stuff where they just
Yeah,
yeah I don't know. That is just guessing and no,
yeah,
I really don't know about that.
yeah.
And
I
I
guess
don't think so.
I'm just trying to drum up a bit more interest in something that we know what's going to happen a month before it's going to happen. But anyway, now we did get a little bit of US data out yesterday. wasn't a busy day by any way, shape, or form. Wholesale inventories came in a negative, as expected, down 0.4%. But perhaps a bit more worrisome was actual trade sales down 1.3%. Now, for those that don't know, inventory metrics are something you're going to hear about or have been hearing about with regarding GDP as a reason why GDP falls. Now, inventories are quite significant for GDP and activity because if you have a healthy market, healthy activity, healthy sales, then inventories are kept high, i.e. stocks are kept high. People order, put it in stock because they think they're going to sell it. They're confident they're going to sell it. So they keep a high inventory. When inventories fall, that means, oh, excuse me, let me shut up the old squawk. When inventories fall, what that tends to mean is that people are perhaps less confident in making sales. So rather than order new goods and keep high stock levels, they eat into their stock levels, or they let the sales eat into their stock levels, which means they're not ordering as much goods, which means that producers might not be producing as many goods. So it has a knock-on effect down the chain, okay, and that overall drop in activity then impacts GDP. So inventory data is fairly important to keep an eye on. The market didn't do much on this number, but as always, we watch the trends in these sort of numbers to see how that's going to affect GDP. Obviously, this is March data, so it's going to be filtering into the Q1 numbers, would have been estimated at first. The next revision will include these sorts of numbers and their effect on whether that GDP changes or not. I would suggest that number there is not going to affect it to the upside at the very least. So that's how you look at inventory data. Just another little fundamental tidbit there for you. We did have a couple of Fed heads out. Fed Collins remains optimistic that inflation can be brought back to 2% in a reasonable amount of time, and with a labour market that remains healthy. So stronger than anticipated inflation and economic activity suggests that achieving the Fed's dual mandate goals may take longer than previously thought, and the progress may be uneven. Says expect some factors underpinning economic resilience will wane, but that current monetary policy stance should slow the economy. Fed Cook was out more with a financial stability hat on, but some of the comments were worth listening to for overall economic impact. Says sees commercial real estate risks as sizable but manageable. Is closely watching rising auto and credit card delinquencies. Says the Treasury market liquidity levels are somewhat low, have been somewhat low recently, but the Treasury market has still functioned well. On that front, we had a 10-year sale yesterday, which by and large was pretty good. It's got the numbers there, but the bid to cover was quite healthy, 2.49 versus 2.34 previously, and the take up was fairly decent as well. No red flags from that one, Kay.
Bit of a tail, but no, I mean, we can, yeah. I'm gonna go with neutral on that one. It's we do see those little tails or throughs sometime, but I mean, if the market would really have been looking at lower yields or bond market to be supported, they would have probably gone in. We would have seen a through, but not a tail. It's got like 1 BP tail. It happens. I wouldn't qualify it as like really exceptional in any way.
No, exactly, and I think that's where the market's at the moment. Unless it's a disaster, it's going to give it limited reaction. Right, over to the big bank meeting of the day, Banxico, Kay. What's coming from those guys over there?
Okay, widely expected to be on hold today, but and also we have to know that the Banxico governance is not a dove, okay, and they are obviously closer to what happens in the US, being the biggest partner, than the rest of LATAM, where the rest of LATAM is rather cutting. Brazil cut yesterday 25 BPs. Will they be tempted? I don't know. We still have got the Mexican CPI to come out actually today, just right at the start of phase. So it may be the last minute clincher. Assuming that everything remains as is, so inflation a bit sticky, hanging around the levels where it was before, they may hold and then signal that they are getting ready, because they are not. The plan is not really to keep those interest rates at 11%, but and the data we have seen some good, some lesser data out. So, but just looking at the sheer level of their interest rates at 11%, you know, I mean, it's yeah, as you can see, the inflation has been coming down, so they may be tempted. Actually, what I thought, they may be tempted to give us a 0.25% and then go completely neutral, or they may decide to hold and signal a few cuts to come, and then it's all going to be about the statements, these bigger cuts, smaller cuts. But I really think the CPI today can be the clincher for what they will decide. So we still have a bit of a question to answer first before really going into Banxico. What
I mean,
I'd
that
say
inflation's looking a bit in the sticky category, isn't it?
exactly.
Yeah.
Exactly. It looks in the last months. So we had one cut, but they could now hide behind the fact that it's been sticky. So that's why I'm saying, I mean, it could be a last minute clincher, this CPI data. Imagine that it's sticky or even ticking up. Then there's absolutely no cut. And then I expect all else equal, the Mexican carry trade just to continue, just because they have such a high interest rate, net interest rate. So I mean, I think we could see a little ahead of the fact, perhaps a bit of covering, book managing on the mix. That's all possible. But then, depending on the decision, I was saying in the room, all else equal, I think that if they cut 25, but then go neutral, we can see the Mexican peso getting a little bit of a slap. But then, market waking up to the fact that they are still running at 10.75%, and the mix will come back. If they hold and signal cuts, the market will probably put on eye flaps and just continue to buy mix. But if the CPI number comes down, then I think the picture may change. Because if the CPI number comes down really, and they cut, then some of those shorter term carry trades or just people thinking that nothing can happen to the mix may be forced to a bit of an exit, at least a temporary one of the kind that we saw in the past months, like get a pretty severe blip, because it's still an emerging market. I mean, it's still moving quite rapidly at times. Then we could get a blip up in things dollar mix and crosses versus the Mexican peso. So I'm really I am really reserving my decision. My overall bias is still for MEX to do well because of those interest rates. Because in the data, been a little bit mixed, but there's nothing alarming really. So I still think it's a good currency to have somewhere, but that CPI and Banxico may change the picture somewhat if the CPI comes in lower.
Yeah, I think you'd probably put a pivot line at that 4% mark for these guys. You know, whereas it's 3% for some of the other majors. Probably if inflation starts getting under that 4% handle,
Oh yeah,
they'll turn
then it's a cut.
far more dovish. Yeah, exactly. Right, from one emerging market currency to another, we come over to the pound and the Bank of England. Obviously, that's the event, the main event today. Forget this. If you're looking at investing, forget that expectation there of 9 voting for unchanged. I don't know what these guys are doing, printing that number. The expectation is 8 for unchanged and 1 for a cut. But we've got 3 things in the mix with the votes. 8-1 is expected. 7-2 is possible also, after Ramsden came out with those dovish comments. I said at the time, if he doesn't vote for a cut at this meeting, it's going to make him look a bit silly after trotting out everything he did in his recent comments. So 7-2 is a prospect as well. Super dovish would be a 6-3, as Kay mentioned, maybe Bailey or someone else moving to the cut side. So 8-1 is expected. A 7-2, I think the expectations are pretty high for a 7-2. So it's probably 50-50 whether it's an 8-1 or a 7-2 as far as the market's concerned. I think for the pound, if it comes in 8-1, that could actually see the pound rise, because it won't be as dovish as the 7-2 as expected. So don't think that if it comes out 8-1, That's as generally expected. The quid's not going to do anything. It might be a little disappointed about that it wasn't a 7-2. Obviously, if it's a 7-2, that's pushing us further towards cuts, a 6-3 even further, and the most dovish outcome. Aside from that, because that's the first indication we'll get the votes. Obviously, no action is expected, no rate change at this meeting. The forecast will be out because it's a forecast meeting, so we get a press conference with Bailey half hour after the announcement. They may or may not impact. It depends if there's any language changes in the statement. For those in our chat room, I did put up a sort of previewette in our news and research room. So if you want to have a look at that, then please do. But the forecasts, they're going to be important to say. If there's no change to the statement, which still is sitting in restrictive territory, i.e. rates are restrictive and they're going to do their job, then the forecasts will tell the market whether to change its timeline or not. Thanks, Kate, putting up, there's a link to that post as well. Then that will change the timeline part of expectations. Apart from that, if there is strong comments shifting from restrictive to we're getting ready to cut, then obviously that's going to push the market to priming when those cuts were going to be. But there's a few permutations. I don't think they jump from restrictive to a cut is coming imminently, but that's my thoughts. They may deem it necessary to do so. There's also some language they can throw in the statement, a phrase "in coming months" that tends to tout policy is going to change imminently. So for the quid, and again, I put this on the post as well. I think you've got to look at a range. It's going to be pretty hard to trade through all the stuff and then through Bailey himself. So I like to pick a price range, as a lot of you know, for where I think the market may, get to a stretch point. Euro sterling pretty easy, up towards 87, down towards 85. I think we're bang in the middle. None of this is going to be a game changer, okay? Even if everyone knows they're going to go to cuts eventually, it's just when. So I don't think anything's going to be a game changer that should bust any big ranges. So that's the range I'll be watching on that side. For cable, similarly, I've picked, 127, 123 is probably a decent range to play in. May not get to any side of it, but if there is big news, it has to break out of those areas to be really big news. So that's where I'll be sort of setting my price stall out. And then Bailey's going to be Bailey, and that could either upset everything or turn it all around. Kay, what are your thoughts on this one and what's happening for the quid? I think just the last thought, the market is leaning dovish going into this one. It wants to see a shift. If it doesn't get that, then obviously pound's going to gain and whatnot, and we'll see the opposite reaction. Your thoughts, mate?
Well, I mean, I was going to say that last little bit that you just said. So, yeah. The thing is, yeah, the market's already trading a dovish Bank of England, right? We've seen. Well, I mean, now they are correcting this move a little bit. Going into the meeting, like we are roughly an hour before now. We've seen the sterling under a bit of pressure. We've seen the euro sterling up. We've been, as I've been saying yesterday, I think the market is already trading or at least managing the books in a way that they're covered also for a dovish meeting. So 7-2, I think, is going to be already sort of baked in the market right now. 8-1 is going already to be a bit of a hawkish surprise. And then we go over to the whole thing about the how should I say, the whatever they think about what's going to happen and stuff. But I think the risk for the 6-3, we cannot underestimate it, because Ramsden and as well Bailey have said that they might start, that they think that we are really on our way to the inflation target, although data tell us something a little different. But we have seen also the house prices come off lately, so I think that gave an extra little impetus to the sellers to keep the pound under the cosh. But yeah, I'm personally going to keep a very open mind going into this meeting, because if they don't give the market what it wants, we have seen that some of the reactions in some currencies can be relatively violent when the market doesn't get what it wants. So watch what's happening in the gilt market, because the bonds are really going to drive it in the end, where they end up. And then yeah, I fully expect Bailey to mess up whatever's been done half an hour before. That is, yeah, I mean,
A given.
he's my favorite worst central banker. We usually sell pounds when Bailey is on, but we have seen a couple of exceptions in the past months. So, but I do fully expect him to mess it up, unless we are seeing a first Bank of England meeting after the directives of Bernie, Ben
Oh yeah, we've got
Bernanke,
Bernie as well.
and
Yeah.
then it's going to be. Then I fully expect a total mess up. I really don't know what really to expect then. But as you were saying, big lines on the euro sterling especially are there. I would say though that on the back of the latest moves in the euro sterling, that 85 figure a quarter is one solid level now, and it's going to take something to break it. If they're uber hawkish, we may get a test of it, but I find this thing has been holding for a year now. And I'm really starting to find this level extremely tough. So it is going to be, on the other hand, mega important as well if a break we would get. But I would lean towards the fact that if we get a bit of a hawkish Bank of England against the market expectations, I think it's still going to be a tough nut to crack. So I'd rather see sterling, because as we have been saying so many times, the market likes to trade the sterling a bit from the emotional side, and likes to make it move quite a bit. I'd say the potential for cable, for the sterling, I mean, in general, to find sellers on rallies is perhaps bigger than to find buyers on dips if the meeting would indeed be soft. So I'm kind of leaning towards towards like whatever happens, it's the sterling strength may not hold perhaps, at least if we're going to get to see decent levels. And then I'm thinking about well, euro sterling, we have just said it, and towards that 126 for a starter in the cable, the high that we printed, those highs we printed after the on Friday, right? Yeah, around there, you know, those 126s, those are going to be really on a hawkish surprise. I think that's going to be a bit of a tough nut to crack, anywhere between 6 and 6.5 on the cable. Just looking at the rest of the dollars as well.
Yeah, very much so. I mean, I looked through the last statement, and it wasn't dovish at all. As I say, they were still in very restrictive stance. There was no hint that, you know, if we get confident, we'll look to lower rates and whatever. Now I know Bailey's obviously said different since, but the statement is obviously what the collective think. So yeah, reading that, my thoughts slightly changed that if they jump to an imminent hike, that'll be a big shift, and I don't think the data puts them in a position to make that big shift yet. A hint, yeah, but not a hint that says rate cuts will be coming in June at least. I still don't think they're going to come in June. I think August at the very earliest. But as we say, you never know with Bailey. It could be a fairly neutral statement, and then he pops up later on and says, "Oh yeah, by the way, we're you know, one more bit of data, and we'll cut in June," and then that all gets upset. So, if you're trading the quid, I think the best way to trade it at the moment is account for the fact that it can be super volatile. You know, this can move 200 pips in a blink if it wants to. Let the dust settle. Judge the move against the information. Obviously, us in the chat room and on Face will be chewing it all over, so you'll know our thoughts about it, and then pick your trade from there. And if the ranges have been tested and they hold, or if we bust under 123 but quickly come back above it, that in itself might be a bit of a signal that there was a bit of a overreaction, and then you just trade it from that front. But yeah, certainly, apart from what I've got in euro sterling already, I wouldn't be putting on a trade just to guess what they might do, because it can just be a bit of a landmine. Anyway, right. Well, Carl, I assume you might have a couple of other quid pairs to look at, Guppy or anything. Do you want to have a quick mooch around the grounds?
Yeah, but if you want to finish on the sterling, because I don't have any other really sterling pairs that I want to look at right now, unless if it's hawkish, for instance, and people would like to be long sterling, I'd say perhaps something like sterling Swiss or so, because that's a low yielder right now, or a lowish yielder. Although if you look at the Swiss crosses, they are not moving an awful lot. If it's dovish, I don't know, stuff like sterling Aussie also, but it's already a little far south. I think in the immediate after Bank of England, it's perhaps best to just stick with the majors like cable or yeah. I mean, that's not even. I'm not even going to start to look at that one. The sterling.
Yeah, I'm trying to tempt you out. You should on that one. Angela asks, is there a chance for a hawkish surprise today? Okay, let's put it in real context. We're not talking about anything hawkish coming. The reality is it's either going to be dovish or not dovish as opposed to hawkish. They'll still keep the optionality in to act if inflation doesn't play ball or go higher, same as everyone else. You know, they won't rule out cuts 100%, but I don't. The move up in the quid will be if they're not as dovish as expected, rather than being hawkish. So yeah, I think it'd have to go a lot to get it going. 127.80, 128. That'd have to be a real surprise. But no, I don't see anything hawkish, but maybe undovish. Sorry, mate.
No, I was while you were finishing, I was reading Gordon's question there. So I'm going to read it. Seeing markets fell from all-time highs with rates near zero and now at new all-time highs. I suspect, Gordon, that you are talking about equity markets with rates at multi-year highs. Could rate cuts actually be bearish as the Fed will be cutting into a weakening economy? Are you talking about equity markets there, Gordon? If you could just reply to that. Indeed. Okay. Yeah. All right. I'll take your question. Yeah, right afterwards. I think it all depends. That's the famous question that has been asked on Face as well. Can equity markets and the dollar go down? It's about the similar kind of question. The answer is clearly yes. If we get a recessionary picture in the US, if really data starts to turn south. And then I'm really thinking about, and I know a lot of people are still mainly watching inflation, but I'm really starting to watch those jobs reports a lot more closer, because if the job market falters, per definition, all the rest will falter, and that is my view. So clearly, if they need to cut because the second part of their mandate is going pear-shaped and the job market is starting to falter, yes, we can see cuts and we can see the equity market come down at the same time. And but that is a recessionary picture. Now, if you go back to what Atlanta Fed now printed yesterday, I don't know where they get their their forecast, but Atlanta Fed GDP now for Q2. So that's one of those a couple of hundred revisions that they do before the real number comes out. So the perception or their perception is for a 4.2% versus the prior 3.3%. So they think that US exceptionalism is just there to stay in Q2. I'm not going to comment on that. I don't know where they get their numbers, but and they can be very jumpy, but they don't.
I could give you a guess, but it would involve swearing.
Oh, okay, yeah, or it must be that they hired people from StatsCan, you know, the
Yeah.
Canadian
Well,
the Canadian
Canadian
Statistic Office
OGP.
that has been, I think, dismantled. Is it, or the whole team got sacked?
The ADP one did, didn't they? The old Canadian ADP.
Yeah,
Remember that one?
that's gone, right?
Yeah,
Yeah,
they
I
got
think
shot
they
that
all
number.
got sacked because it was like they had revisions of 500,000, 500,000 employees from one month to another, and which was a bit
I
was a
miss
bit.
those guys. They went to my most favourite data point after
Yeah, I
the
guess so.
own
Yeah,
consumer confidence.
yeah, I guess
But
so.
anyway,
Yeah. Oh,
yeah,
okay. So,
well,
so that
I'll
to
pass it
reply
over
to
to you, mate.
Gordon, I mean, it's all possible, you know, but we need to see a really turn for the worse. Okay. The first reaction, like we saw on the prior last Friday's NFP jobs report, by the way, is still that the market is taking a small negative as positive for the equity markets because the things were not falling out of bed. We were still below 4% unemployment rate. Yes, unemployment was coming down, but they still printed, what is it, 175K jobs or so. We are still not below that 100 or 80K line, which is compared to former years, it's apparently where we needed somewhere 150, 200K to really have like job creation. Apparently, with all the distortion in the pandemic, and now this number is closer to 100 or 80K right now. I'm not a statistician, I'm not an economist, so I don't know the exact number. But we're still well above that threshold. Even the older one, we're still well within job creation territory. So for now, slightly weaker reports will still be positive, but you will need to see like really bad ones. If you get like a string of zero, and the unemployment rate. Sorry, I was searching my word because I was reading something else at the same time. The unemployment rate is starting to go 4.5 and above. Then I think the picture may start to change a bit. Okay, that is what needs to happen for it to really turn around. Okay, I'm done with
Yeah.
that.
Yeah, thanks, mate. I shall pass it over to you. And yeah, I think it's to echo Kate. It's going to be it's a matter of scale. You know, if we start seeing -3% GDP, that's when stocks won't like it. If it's just like we've seen in Europe and the UK, where we're bumping along the 0%, minus 0.2, plus 0.1, then stocks will probably stay well afloat, shall we say. Right, over to you, mate. You're on mute, mate.
Whoops. Okay, I was muted. Just a quick one on this euro dollar. Although it's not doing an awful lot, it does seem like we are just creeping, like leaking very slowly because the US yields are just ticking up that slight bit. I still would think that low 107s here should be the first first level to look at. I'm slightly small short because I think it's just the laws of gravity playing here. The dollar is still not ready to give it all up. So, but I'm really playing it on the safe side. I've already started to buy a little bit back around those prior lows here. Just playing it from a little bit the short side for as long as we are below 108 really. I don't think we are going to go anywhere far this afternoon. We have those U.S. Initial jobless claims, but I mean, there's much bigger fish to fry, and those have been very, very stable of late. I don't think they are a real market mover. One interesting one, and I thought Ryan was going to talk about this dollar cat because we do have McClem apparently this afternoon. Oh, it's on the financial system review. Okay, sorry, I just saw the the subject. And I don't think that's going to be a biggie. Everything is relatively stable over there. But we did try to overshoot a little bit this trend line. We went up to the 23.6 in the docket, and now we're shying away from it. Okay. Ryan, by the way, had a very, very, very good trade on these, picking up the lows here on Friday. We should respect this, I think, the 137.50-60, let's call it. But I also think that anywhere, if we get closer to 137 or a bit below, I think around high 136s should now find a bit of interest on the buy side, because we have been turning around, but we finally broke out of this wedge. And I think around here we should see a bit of interest. For one, if I see a level down there, I may just try to pick up some. And then I wanted to have a look at yeah, it does look a bit flaggy, does it? And then I'm going to have a look at the emergings, because we are having Banxico today. Okay, so I think this could actually flatline until this should flatline until the CPI, and then we will see on the back of the CPI whether the market will use the 6 hours between the CPI release and the Banxico to manage positions more. But I would say that any move on the back of if it smalls lower, okay, not if it really drops away, but if it smalls lower, we may actually have a look back above 17, even go up to 17.10 or so before the Banxico. If you get a sticky inflation, we may just flatline a little bit and then wait for Banxico. But I would be very careful if post Banxico we start to break levels here, 1678, 1680. 82. If that starts to break after the Banxico, then I think it's we are going to be in for a fresh round of Mexican peso strength. Now, I've also said in the room, don't forget that when we were around here, and even when we were back in 2023, when we were around here, we had those kind of comments, and even the Labrador, Lopez Obrador, the president, was even saying that he found Mexican peso to be a bit strong. So be a bit careful with if ever dollar mex is starting to break levels below here again, around that 16.5. Okay, so I'd say all else, everything unchanged, I think we can see Mexican strength. Okay, but be careful when we start to trade in this zone. And then I'm going back onto Euromex, because I'm still keeping an extremely close eye on this one, because any hint, and as I said, I'm still biased to buy Mexican peso. Any hint at anything weaker or stuff to come, we may see a bit of a retracement here. 1840s, we are turning around 1820 right now. Max 1850s. Okay, if it goes through 1850s, then I think I need to reassess what's going on. But if we see a move up here and a failing again, and that is on a slightly dovish tilt, that is either 25 neutral, this could cause it, or hold, but talking about imminent or very soon to cut, could also see a little bit, but then I think we are not going to get even that high. But and I would give it a go. If everything is neutral, and if we see that CPI not coming down, then I think this has room now again to or at least continue to trade this global trend lower, and then we're probably on our way to sub 18 again. So that's a bit my view on the mix going into the Banxico today. And with that, Ryan, back over to you, my friend.
Thank you very much, kind sir. Good stuff as always. Well, there's nothing more to be said. We're in the zone. All we can do now is trade these events coming up, Banxico, BOE, whatever we've got coming. So trade safe, everybody. Thank you as always for coming to the Flow Show, and we will see you all tomorrow. We'll digest the mess that Bailey's left us, no doubt. Have a good day, everybody. Thanks a lot.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.